Imagine waking up tomorrow and discovering that the modern economy quietly depends on people staying in debt, not just borrowing occasionally, but continuously carrying mortgages, credit cards, auto loans, and financing plans that stretch across years or even decades. For most individuals, debt feels like a personal burden that needs to be eliminated. People are taught that financial success means paying everything off, avoiding interest, and eventually becoming completely debt-free. But when you step back and look at the system as a whole, something surprising begins to appear. The modern economy does not simply tolerate debt. In many ways, it quietly relies on it. To understand why, we need to look at how economic growth actually works. Economies grow when businesses sell products and services, and those businesses depend on millions of customers continuing to spend money every single day. When consumers spend more, companies earn more revenue. When companies earn more revenue, they hire workers, expand production, and invest in new opportunities. Those new jobs create wages, and those wages allow people to spend again. This cycle between spending, business growth, and employment is what keeps the economy moving forward. But there is one major limitation to this system. Household spending is naturally limited by income. Most people can only spend the money they currently have. If income grows slowly, spending also grows slowly. For decades, wages in many developed economies have increased at a gradual pace. At the same time, the cost of housing, education, healthcare, and daily living has risen steadily. This creates a gap between what people earn and what many things cost. Without credit, large purchases would require long periods of saving. A house might take 20 years of savings before becoming affordable. A college education could require an entire decade of financial preparation. For businesses, this would slow economic activity dramatically. Fewer people would be able to buy homes, cars, and expensive goods. This is where credit changes everything. Instead of waiting years to save enough money, consumers can borrow today and repay gradually in the future. Without credit, only people with large savings could afford major purchases. With credit, millions of additional consumers can enter the market. A young family that has not saved hundreds of thousands of dollars can still buy a home using a mortgage. Monthly payments replace the need to accumulate the entire purchase price in advance. The same logic applies to many other industries. Auto loans allow people to purchase vehicles immediately instead of saving for years. Student loans allow students to attend universities before they have the income to pay tuition. Credit cards allow people to buy products today and repay the balance over time. Each form of credit expands the number of people who can participate in the economy. For businesses, this dramatically increases demand. More home buyers mean more houses being built. More car buyers mean more vehicles being manufactured. More students enrolling in universities means more expansion in education. Credit acts like a bridge between present needs and future income. Instead of waiting for money to accumulate slowly, the system allows spending to happen immediately. This acceleration is one of the reasons modern economies grew so rapidly during the 20th century. Housing construction exploded once mortgages became widely available. Entire suburbs appeared across countries as families gained access to long-term home loans. Automobile ownership expanded dramatically once car financing became common. Instead of paying the entire cost up front, buyers could spread payments across several years. Retail spending also changed when credit cards became popular. Consumers gained the ability to make purchases even when their bank accounts were temporarily low. All of these systems increased economic activity by allowing purchases to happen earlier. But there is another reason debt became so powerful in modern economies. Debt does not only create spending once, it creates a long chain of financial activity that continues for years. When someone buys a house using a mortgage, the purchase itself happens instantly, but the financial consequences continue for decades. Every month, the homeowner sends a payment to the lender. Part of that payment goes toward the loan balance, while another portion goes toward interest. Interest becomes income for banks, investors, and financial institutions. A single home purchase can generate hundreds of payments over 30 years. Multiply that by millions of homes, and the scale becomes enormous. The housing market alone creates a massive stream of money flowing through financial markets every month. Credit cards create similar patterns. A simple purchase at a store may take seconds to complete, but if the balance is not paid immediately, interest begins accumulating. The borrower may repay that purchase over several months or even years. During that time, interest payments continue flowing to lenders. For borrowers, this may feel like a long financial obligation. For the financial system, it creates predictable streams of income. Banks depend on those income streams. Investment funds depend on them as well. Pension funds often rely on interest payments from loans and financial securities to support retirees. In other words, the debt carried by millions of households becomes the income received by large financial institutions. This connection is much stronger than most people realize. A mortgage payment made by a homeowner may eventually flow through banks and investment markets before reaching retirement funds. Credit card interest may travel through financial institutions and become part of an investor's portfolio return. This system turns personal borrowing into a large network of financial activity. But this structure also reveals something unusual about the economy. The system works best when these payment streams continue for long periods of time. Long-term loans create stable and predictable income for financial markets. A 30-year mortgage produces decades of payments. A 7-year auto loan creates a steady stream of income over several years. Credit cards allow balances to roll forward month after month. From the perspective of financial institutions, these long payment timelines are extremely valuable. They create stability and predictability. Investors can estimate future income based on millions of borrowers continuing to make regular payments. But this leads to a question many people never consider. What would happen if millions of households suddenly stopped borrowing? At first glance, that might seem like a positive outcome. People would avoid interest payments and gain greater financial independence. Households would rely only on money they already possess, but the effect on the broader economy would be dramatic. If borrowing slowed significantly, consumer spending would decline, fewer homes would be purchased, fewer cars would be financed, retail spending would fall as credit card usage declined, businesses would experience lower demand for their products, factories would reduce production, construction projects would slow, hiring would become more cautious, economic growth would weaken. This is why governments and central banks pay close attention to borrowing patterns. When economic activity slows, interest rates are often reduced. Lower interest rates make borrowing cheaper and encourage consumers to take loans. Mortgage payments become more affordable, but businesses gain easier access to financing. Consumers become more willing to spend. The goal is not simply to increase debt for its own sake. The goal is to keep economic activity moving. Spending keeps businesses operating. Businesses keep workers employed. Workers earn wages and repay loans. Those repayments support banks and investors, and the cycle continues. The modern economy is built around this loop. Credit pulls future income into the present. Consumers spend that borrowed money. Businesses earn revenue from those purchases. Workers receive wages from those businesses. Those wages eventually repay the loans that funded the spending. Then new loans appear, restarting the process. From a distance, the economy begins to look like a continuous cycle, powered by borrowing and repayment. Debt fuels spending. Spending fuels growth. Growth supports employment. Employment produces income that repays existing debt. But once you begin looking closely at this cycle, you start noticing something interesting. Debt is not simply a side effect of economic growth. In many ways, it has become one of the central mechanisms that keeps the system moving, and that realization leads to a deeper question. If the economy relies so heavily on borrowing and long-term repayment, what happens when too many people try to escape debt completely? That question reveals an important tension at the heart of modern economic systems. Individuals often want to become debt-free, but the system around them often depends on continued borrowing to maintain momentum. And once you understand how deeply debt is embedded in the structure of the modern economy, you begin to see something surprising. Debt is not just a financial tool. In many ways, it has become one of the foundations that keeps the entire economy running. Once you start understanding how deeply borrowing is connected to economic growth, another layer of the system begins to appear. Debt does not only affect spending, it slowly begins to shape human behavior, career decisions, and even the level of risk people are willing to take in their lives. A person who has no major financial obligations usually has more flexibility in their decisions. They can change jobs more easily, start a business, take time off, or move to a new city without immediately worrying about fixed monthly payments waiting for them. But the moment long-term debt enters the picture, the situation begins to change. A mortgage, a car loan, student loans, and credit card balances create a chain of financial commitments that must be honored every single month, regardless of whether life becomes stable or unpredictable. When those payments exist, financial freedom becomes closely tied to maintaining a reliable income. People may still change careers or pursue new opportunities, but the pressure to keep income flowing becomes much stronger than it would be without those obligations. This is one of the subtle ways debt connects individuals to the broader economic system. Long-term borrowing often means long-term participation in the workforce, because the income earned from employment becomes the primary method of servicing those financial commitments. From the perspective of the entire economy, This behavior creates a form of stability. Millions of households wake up every month knowing that their mortgage, car loan, or credit card payment is approaching, which means they continue earning, working, and participating in the system in very predictable ways. Financial institutions depend heavily on this predictability. Banks and lenders build their business models around the expectation that millions of borrowers will continue making regular payments for years or even decades. Those payments are not only important for banks themselves, they also form the foundation of many financial investments held by pension funds, insurance companies, and institutional investors around the world. When a homeowner makes a monthly mortgage payment, the money rarely stays in one place. It often travels through financial institutions and investment structures before eventually reaching investors who depend on those payments for income. This is why long-term loans became such a powerful component of modern financial markets. A 30-year mortgage does not only finance a house, it also creates 3 decades of predictable cash flow that can be measured, modeled, and sold within the financial system. Over time, banks began combining thousands of these loans into large pools. These pools were then converted into financial securities that investors could buy, allowing them to receive a portion of the future payments made by borrowers. This process connected ordinary consumer borrowing to global capital markets. A mortgage issued in one city could eventually become part of an investment portfolio, held by a pension fund on the other side of the world. For many years, this system appeared extremely efficient. Consumers gained access to credit, banks earned interest and fees, investors received predictable income streams, and businesses benefited from increased spending throughout the economy. The availability of credit expanded markets dramatically. Homes, cars, electronics, education, and countless other industries experienced enormous growth once financing options became widely available to ordinary consumers. But as borrowing expanded across the economy, debt levels began rising faster than many people realized. Households were no longer borrowing occasionally for large purchases. Borrowing gradually became a permanent part of everyday financial life. Instead of saving for years before making a purchase, consumers increasingly relied on financing to bridge the gap between their current income and the cost of the things they wanted or needed. At first, this shift seemed manageable. As long as incomes continued growing and borrowers continued making payments, the system kept functioning smoothly. However, problems can begin when debt expands faster than the income required to support it. When too many borrowers struggle to keep up with payments, financial stress can spread quickly through the system. The global financial crisis of 2008 demonstrated how fragile this balance can become. During the years leading up to that crisis, mortgage lending expanded rapidly and housing prices continued rising, creating the impression that the system was stable and sustainable. Many lenders issued mortgages to borrowers who had weaker financial profiles, assuming that rising home prices would protect both borrowers and lenders from serious losses. Those mortgages were then bundled into complex financial products and sold to investors across global markets. As long as housing prices continued climbing, very few people questioned whether the structure carried deeper risks. But when housing prices stopped rising and eventually began falling, the weaknesses in the system quickly appeared. Some homeowners suddenly owed more on their mortgages than their homes were worth, making it extremely difficult for them to refinance or sell their properties. At the same time, some borrowers began struggling with monthly payments as economic conditions weakened. Foreclosures started increasing, and those missed payments began affecting the financial securities built from those mortgages. Because the loans had been distributed throughout the financial system, the losses did not remain isolated within individual banks. They spread through investment funds, financial institutions, and markets across multiple countries. Confidence in the credit system began to collapse. Banks became more cautious about lending. Investors became uncertain about the value of loan-based securities, and credit availability across the economy tightened dramatically. Once borrowing slowed, consumer spending began declining as well. Businesses experienced lower demand, production slowed, hiring weakened, and the broader economy entered a severe downturn. The crisis revealed something many people had not fully realized before. Modern economies rely heavily on the continuous flow of credit, and when that flow suddenly slows or stops, the effects can ripple across nearly every sector of the economy. Because of this, governments and central banks often intervene during financial crises. They lower interest rates, provide liquidity to banks, and attempt to restore confidence in the financial system so that lending and borrowing can resume. Interest rates play a particularly powerful role in guiding this process. When interest rates fall, borrowing becomes cheaper and more attractive, encouraging consumers and businesses to take loans and continue spending. When interest rates rise, borrowing becomes more expensive, which slows spending and reduces financial pressure during periods of excessive inflation or rapid credit expansion. This balancing act between encouraging growth and preventing excessive debt has become one of the central challenges of modern economic management, even with careful policies. However, one reality remains clear. Debt is deeply woven into the structure of how modern economies grow and operate. Housing markets depend heavily on mortgages to function at their current scale. The automobile industry relies on financing to make vehicles accessible to millions of buyers. Higher education systems in many countries rely on student loans to allow large numbers of students to attend universities. Retail markets benefit from credit cards that allow consumers to make purchases even when cash is temporarily limited. Each of these industries contributes significantly to employment, production, and economic growth. When credit expands, these sectors often grow quickly, and when credit tightens, they can slow just as rapidly. From a broader perspective, debt acts like a mechanism that pulls future economic activity into the present. Instead of waiting years for consumers to accumulate savings, the system allows them to spend future income today. Businesses receive revenue earlier, workers receive wages sooner, and economic activity accelerates. Later, the income generated by that activity gradually repays the loans that made the original spending possible. This is why debt can feel both powerful and dangerous at the same time. It creates opportunities that might otherwise require many years of saving, but it also commits borrowers to long periods of repayment. When millions of households participate in this pattern simultaneously, their borrowing and repayment become part of a much larger economic engine. Every mortgage payment, every auto loan installment, and every credit card balance contributes to the flow of money moving through financial institutions and investment markets. The modern economy is not simply built on production and consumption. It is also built on a continuous cycle of borrowing, spending, earning, and repaying. Once you recognize this structure, the idea that the economy encourages debt begins to make more sense. It is not about forcing individuals to remain financially trapped, but about maintaining a system where credit keeps economic activity moving forward. And that realization reveals something important about the world we live in today. Debt is not just a financial tool used occasionally by consumers. It has become one of the central mechanisms powering modern economic growth.